Good evening, everyone. A very hearty and warm welcome for today's webcast on decoding audit and compliances of private limited companies under the Companies Act. As professionals navigating the evolving landscape of corporate governance and regulatory frameworks, it is imperative that we stay well informed about the audit requirements and the compliances obligation that impact private limited companies. Today, we are privileged to have CA Kintan Maru with us as a moderator of the webinar and CA Kamal Garg sir as a speaker for this webinar. We also have CA Babu Ibrahim, who is the Chairman Corporate Laws and Corporate Governance Committee. Under his expert guidance, we are taking this committee forward. A brief introduction of CA Kintan Maru. He is a fellow chartered accountant with 14 plus years of experience in assurance and taxation. He specializes in statutory audits, IFC, corporate tax, startup advisory, and litigation support. Over to you, sir.
Good evening, everyone. First and foremost, I welcome CA Babu sir, an eminent chartered accountant, a respected figure in India's professional accounting community. Known for his unwavering dedication to the profession, Babu sir brings a wealth of experience in audit, assurance, and financial governance. He currently serves as a Central Council member of ICAI, where he actively contributes to various committees focused on standards, ethical standards, reforms, and capacity building. He is currently the chairman of Corporate Laws and Corporate Governance Committee of ICAI for the term 25-26. Babu sir, over to you for a minute so that we can enrich the audience today. Babu sir, your speaker is on mute.
Very good evening. Welcome to all participants who have joined across the country. Distinguished speaker of this evening, an eminent expert on corporate law and widely sought after teacher and speaker, CA Kamal Garg, moderator of the session, Kindan Maru, and Secretary CLCGC, Seema, and very distinguished participants who have joined across the country. As all of us will agree that audit of private limited companies is one of the most important area of professional practice for us. Today we have close to 1.73 million private limited companies registered in the country. And I'm very sure that every chartered accountant in practice will have few audit of private limited companies. Therefore, this is one area which is of importance for all of us. Compliance with the accounting standards, compliance with the standards on auditing, which are all made mandatory under the Companies Act, and lot of compliance requirements under the Companies Act of 2013. Therefore, these are all important sessions which can have, I'm sure many of you have been quite aware of that, but this gives you an update of what are the latest changes and to give you a fresh look what are the compliances required, what I'm supposed to do in the case of an audit of a private limited company, which all of us have. Therefore, I'm sure we got one of the best speakers to enlighten on that. And thank you for all of you joining together in large numbers on this webinar. This is the first webinar organized by Corporate Law and Corporate Governance Committee of the ICA for the year 25-26. And we will keep on. Today, in fact, we had a meeting with the Joint Secretary of Ministry of Corporate Affairs to streamline the entire filing process in NCA 21, V3 version. Therefore, we have pledged our support. In fact, they valued our support, and in the original launch, in fact, ICA has totally partnered with NCA in the MCA 21 project, and they wanted our continued support. Therefore, if you have any issues on MCA 21 which is not getting resolved, please write to clcgc@ica.in, and we assure you that we will find solution for that. We'll take it up with the appropriate authorities with the MCA. This is one important project which we have taken up. And like that, if you have any suggestions to improve the corporate governance, in fact, we are also shortly planning to launch a certificate course on corporate law, because that is one of our key areas of practice, and many of our members are wanting for that. Today, in fact, we launched the 12th batch of the certificate course on CSR. Therefore, we are also planning a lot of host of other activities. Keep visiting our website for various updates, and over to you for a great 2 hour learning. Over to Kamal Gaji.
Thank you, Chairman Babu sir, for this enlightening experience. The figure of 1.7 million private limited companies, which you highlighted, speaks volume of the very importance of this session. Now I will take a moment to introduce today's speaker. It is my privilege to introduce CA Kamal Garg, a distinguished fellow member of ICAI, an accomplished academician, having graduated with first class honors in commerce from University of Delhi. He has further augmented his profession acumen by attaining diploma in DISA from ICAI. He is a registered insolvency professional under the IBBI. He also holds multiple certifications from ICAI and NISM in BRSR, social auditing, online dispute resolution, social listing, and municipal bonds. Speaker Mr. Garg has numerous prestigious roles within ICAI, including being part of Board of Studies, Accounting Standard Board, Ind AS Implementation Committee, and many others. He is actively involved as a technical reviewer, committee resource person, and expert panel member in statutory audit and financial reporting matters. He has represented ICAI internationally, addressing members of National Board of Accountants and Auditors in Tanzania, and has contributed to regulatory projects under IBBI. Notably, he has provided training to CBI inspectors as well under insolvency and bankruptcy law. A prolific author, Mr. Garg has authored a dozen authoritative books on practical guides on subject ranging from Ind AS, IFRS auditing standards, Companies Act, IBC, CSR, international taxation, which are published by reputed publishing house such as Walter, Kluwer's, Bharat Law Books, and many other publications. His thoughtful leadership is evident in his numerous articles and publications featured in ICAI newsletter and very much renowned journals covering complex areas such as FBT, MAD, FEMA, ECB. He brings his wealth of experience in corporate laws, audits, and management consultancy and continues to be a highly sought after speaker and mentor across various platforms, including ICAI and ICSI. With this brief background and with today's background and session, we are honored to welcome him today to share his valuable insights and expertise. So over to you, Mr. Garg. The stage is all yours, and we are looking forward to an insightful session.
Thank you, Kintanji, for this warm introduction. And I must first of all congratulate Babuji to come at the helm of affairs in ICAI, a good friend of mine and my senior mentor as well. Thank you, Babu sir, for inviting me to this program. Thank you, Seema ji, also for giving me this accommodation in this program today. Now, before I share my screen and discuss the topic for the day, let me ask you certain questions, and my questions would be quite on a very pragmatic note. When we do audits of private limited companies, are we much more focused only on vouching verification, or are we deep diving into the legal requirements as well? If I raise certain questions before the house, question number one is, which I will discuss in detail, obviously. Question number one is, suppose that I will take this liberty to take the name of Mr. Kintan in my example. Suppose that Mr. Kintan is the statutory auditor of RST Private Limited, a company being a private limited company. Now, Mr. Kintan is also proposed to be appointed as tax auditor of RST Private Limited. So without searching on Google or without searching on ChatGPT, please consider and answer my question in your heart, whether Mr. Kintan needs to have a board resolution from RST Private Limited regarding his appointment as tax auditor as well. This is my first question. Second question is, RST Private Limited wish to borrow term loan from a bank. Now, question arises whether this borrowing power is restricted in context of a private limited company or not. Third question is, which I believe is most of the fellow professionals are not embarking upon. Third question is, even today people are confused whether CARO is applicable on a small company or not, especially when a private company is having a borrowing of more than rupees 1 crore. So we will discuss that also. Other question would be about CSR. How to present CSR is not the agenda. Evaluating whether CSR is applicable or not is the agenda, which I will discuss in detail. I have seen that chartered accountants, company secretaries, and many other professionals for that matter, may at times overlook applicability of CSR itself. Then comes CSR spending, which is a separate discussion. Moving forward, I will be having one very big question to the House. The question would be whether a private company is allowed to accept deposits from the members. When I say members, that means the shareholders per se. So can a private company accept deposits from the shareholders, members? Because at times I have seen and I have observed that this question always creates confusion. Most of the people are of the view that a private company can accept deposits only from directors, and that too subject to certain formalities and conditions. But the question limelight says whether a private company is allowed or not to accept deposit from the members or the shareholders. So these would be the kind of questions, and some more typical questions will come up. Like one question would be about discussing on ceiling or number of audits. The confusion prevails in the industry of auditors, whether as a statutory auditor I can take 20 audits or 30 audits. That is the confusion. So we will discuss all these things, and I will also take up your questions towards the end of my discussion. Kintanji, just confirm me once my screen is visible to you. I'm sharing my screen.
Sure.
Kintanji, my screen is visible?
Yeah, it's clearly visible.
Thank you. So people, let us discuss this topic in detail, and my approach would be a case study based approach. So it will be very easy to understand, and you will be able to correlate with the practical world also. The topic given to me is decoding audit and compliances of private limited companies under the Companies Act 2013. So I place before the House the first question of my deliberation. The question is, in respect of statutory audit cum tax audit, do you have a board resolution for being appointed as auditor, that is tax auditor? So let us create a case study for this. This is the case study. I will give it 30 seconds to respond back in the chat box if it is possible for you. The question is, RST Private Limited is the company, and you are appointed as statutory auditor at the AGM. You have also filed ATT1 for the same. You're also carrying out the tax audit of RST Private Limited. So now in this case, what is happening? You are the statutory auditor as well as the tax auditor of RST Private Limited. ADT1 is filed vis-a-vis the capacity of being a statutory auditor. But when it comes to the tax audit, it was not discussed at the board meeting or at the annual general meeting of RST Private Limited. Maybe the CFO or the director of finance has issued a letter of appointment to you that please also carry out my tax audit. So the question for the House is there any requirement to have the board resolution for appointment as tax auditor of the same company of which you are the statutory auditor? That is my question. And Kintanji, if you can help me, I don't know whether it is possible for the audience to reply or not. If it is possible, please tell me if answers are there.
Sure, I will let you know.
So this is, in my experience, this is one of the area where lapses are taking place. So let us discuss in detail. The question is, if you are going to be appointed as statutory auditor cum tax auditor of the same private limited company, whether board resolution is required or not, vis-a-vis the capacity of tax auditor. For this purpose, we need to deep dive into section number 144. I repeat and emphasize section number 144 of Companies Act. I put the section on screen for you. Just see the initial words of section 144.
Hello, sir. By the time Kamalji, you are putting the screen, let me address all of you for a moment.
Welcome to the
So,
good evening.
well, Chairman, sir, hello.
Chairperson Kriti Savla has joined us.
Hello, sir. A very respected chairman of the committee, Sri Babu Abram ji, and the speaker, Kamal Garg ji, and the moderator, Kintan, and all dear participants. This is an endeavor to serve all of you the best. Taking the charge of this committee along with the chairman, as a vice chairman, myself, Sri Kriti Savla, we want to ensure all of you that whatever we can serve the best, we will do that. With the starting of this webinar series, and every week we are planning to come out with these webinars. We request you, all of you, to please come as a speaker, moderator, and also suggest the initiatives which we can take for the interest of the entire fraternity and the stakeholders. With these words, I welcome all of you and want to ensure with all these initiatives for the members at large. And I'm sure under the leadership of our chairman, we will do the best. And I also acknowledge the efforts of our committee secretary, Seema, and entire team. Thank you very much.
Thank you,
Over to
Preeti.
chairman, sir.
Yeah.
Over to Kidan, I think Kamal Gaji.
Okay. Yeah.
Kidan, I think.
Thank
You
you,
can
Vice
take.
Chairman. Thank you, Vice Chairpersonship, Shri Preeti Savla, for addressing us. Preeti Savla, Madam, is currently serving as a Central Council member, and she plays an active role in formulation, planning, and regular development. And she has worked in very deeply in ESG frameworks and capacity building for the benefit of all the members. So, with this, we thank both the chairman and vice chairmanship for presence. And it's over to Kamal sir again, so that we can continue with the session.
So the question which we were pondering over was whether a board resolution is required or not for appointment of a chartered accountant as tax auditor cum statutory auditor. And I was highlighting section 144 of Companies Act. So see the initial words of section 144, what it says. An auditor appointed under this act, that means the statutory auditor. This act means the Companies Act. It says shall provide to the company only such other services as are approved by the board of directors or audit committee as the case may be. I will stop myself here. Generally, people understand that section 144 enlists only those services which are prohibited services. But if you see the initial words of section 144, what it says that you being a statutory auditor are also allowed to provide certain other services provided they're approved by the board or audit committee as the case may be. Meaning thereby, we need to ask ourselves a question, whether providing tax audit service to the same company of which you are the statutory auditor, whether that tax audit service falls into the category of prohibited service or not. Answer is no. Section 144 is not prohibiting a statutory auditor to provide tax auditor service as well. Meaning thereby, it should be a learning for each one of us that if you are going to tax audit the same company of which you are the statutory auditor, please also ensure that you must have the board resolution for the purpose of such an appointment by virtue of section 144 of Companies Act 2030. I believe this point is clear to most of the people who are listening me. Now, having said that, the correct answer would be yes, the board resolution is required. And why? Because of section number 144 of Companies Act. Having said that, let us move to the other case study for discussion dealing with borrowings by the private company. It's a very big misconception that people do say section number 180 subsection 1 clause C deals with the borrowing powers. It's a misconception that private companies are altogether exempted from the clutches of section 181C. Before I discuss in detail exemption notification for private companies, let us first understand what section number 181C says. Section number 180 subsection 1 clause C of the Companies Act states that a public company needs to obtain special resolution approval. I am discussing public company, but I will come to private company in a while. A public company needs to obtain special resolution approval if the borrowings, that is the current borrowings plus proposed borrowings, are going beyond the aggregate of paid up share capital plus free reserves plus securities free account. So if the left-hand side exceeds the right-hand side of this equation, then special resolution approval is required. Now this clause number C of section 181 primarily is meant for public companies. Why I am saying this thing? In June 2015, one notification come from MCA side. And that notification was saying that section number 181C is not applicable to private companies. Now please be very careful what I am saying. In June 2015, the notification was given by MCA, popularly called as exemption notification. And it stated that section number 181C is not applicable to private limited companies. So people were of the opinion that yes, private companies are altogether exempted, which is correct. Now what happened going forward in June 2017, another notification came, and what it stated, the notification stated that the exemption available to private companies from the clutches of section 181C will be available only when there is no annual filing default. Just see this chart. What the 2017 notification stated? The 2017 notification stated that exemption is available to private company which has not committed, I emphasize the word not, which has not committed a default in filing its financial statements under section 137 of the Companies Act or annual return under section number 92 of the Companies Act. Meaning thereby, try to understand, meaning thereby, if the financial year, say, is 24-25, if the financial is 24-25, and in the month of, let us say, May 24, the private company wish to avail term loan from a bank, but the private company has not made annual filing of the last year, then this exemption is not available. Then this private company can avail the loan only after passing special resolution. So what is the crux coming up? The crux coming up is special resolution approval in general is not required because section 181C is not applicable to private companies. But as statutory auditors, please do check whether that private company has made any default in annual filing or not. If on the date of filing application for availing loan, default is there in annual filing, then the private company cannot pursue that application for availing the loan unless and until special resolution approval is passed as per this requirement. Now, what comes in the definition of borrowings? That is also again very important. The law says no SR approval is required for temporary loans, meaning thereby in the word borrowing, temporary loans are not covered. The question arises, what are these temporary loans? Temporary loans means those loans which are repayable on demand or are repayable within 6 months from the date of availing the loan, like cash credits, overdrafts, something like that. Be very careful. What the law say that temporary loans are not covered, but please be careful who is the lender here. The lender here is company's bankers. So if the loan is going to be taken from NBFC or any public financial institution, then this exemption again is not available because only those temporary loans which are obtained from company's bankers, they are excluded. And more importantly, the law says the temporary loan will not include the loans which are raised for capital expenditure. So ultimately, if I say a single liner crux is if RST Private Limited has made annual filing default, then on the date of approaching the bank for availing term loan, you must have special resolution approval ready with you. Else it will be a default, which will warrant a qualification by the statutory auditors, not only on the face of the audit report, but in company's audit report order as well. To make you understand this clause number C of section 180 subsection 1, I place before the house one question to have the calculation analysis. Assume that the data pertains to company RST Private Limited, and there are two cases, case 1, case 2, respectively, for the data of paid up capital and proposed loans. You assume that the private company has defaulted in annual filing. I repeat, you assume that this private company RST Private Limited has made a default in filing, that is annual filing in section 137 or section number 92. Having taken that assumption, please tell me in which of the cases, as per your wisdom, special resolution approval is required, or at all it is not required. So we have two cases, case 1, case 2, and the data pertains to paid up capital, free reserves plus securities stream account. Then we have the data about the loan, outstanding working capital loan. So this O/S means outstanding, WC means working capital, outstanding working capital loan, repayable on demand to GE Capital, then cash credit from Punjab National Bank, repayable on demand, existing, this is the existing amount. Then 6 months loan for plant from Punjab National Bank, it is proposed. Then 24 months loan for plant from Punjab National Bank, it is again proposed. So you have the entire data with you, take 30-40 seconds and then tell me if I assume that RST Private Limited has defaulted in annual filing, then whether on the basis of this respective data in case 1, case 2, special resolution approval is required or not for undertaking this borrowing transaction. You may have a revisit on this equation, which is visible now on the screen. So with this very equation scenario, analyze whether special resolution approval is required or not in any of these cases. So one thing is very certain and apparent, rupees 170 will remain constant. That is the sum total of paid up capital, free reserves and securities in account. There is no change into it. It will remain constant in both cases, case 1 as well as case 2. Now what we need to analyze, whether the borrowing existing plus proposed exceeds rupees 170 or not. If there will be excessive amount beyond 170, then we will be able to conclude that special resolution approval is required. Now, if I go to the equation for borrowings, we have 1, 2, 3, 4, 4 borrowings being given. We need to check out of these 4 borrowings, is there any amount which falls into the group of temporary loans? So let us first analyze, is there a temporary loan present or not? So if I go one by one, we have outstanding working capital loan, repayable on demand from G Capital. Whether it is temporary loan, answer is no. Why it is not a temporary loan? Although this is working capital loan, repayable on demand, but this loan is obtained from NBFC, that is G Capital. It is not obtained from company's bankers. So that means it is not a temporary loan. That means I will take it in my equation. Then is cash credit from Punjab National Bank, repayable on demand, existing. It is existing. So we need to ask ourselves whether this PNB cash credit is a temporary loan. Answer is yes. Then is 6 months loan from Punjab National Bank, but for what purpose? Plant. Although the tenure is 6 months, the loan
It's
is also
capital.
taken from company's bankers, but it's for capex. And
Capex.
if you remember this slide, just see last note, temporary loans do not include the loans raised for the purpose of financing capital expenditure. So despite 2 things being satisfied, that it is from company's bankers and the tenure is also within the tenure of 6 months, still it will not qualify to be outside the equation. Why? Because it is for capex. So that means this loan is also includable in my equation. Then is 24-month loan for plant. Again, capex loan from bankers, and the period is also more than 6 months. So it will also be in my equation. Now, because it is in my equation, so what we can say, let's see here, this, and this will go into my equation. So if you see the grand total 170 and compare with this other total of first case 50 plus 50 plus 30, 130, that is the borrowings other than temporary loans. Now this 130 is within the whole maximum cap of 170. That means special resolution approval is not required.
Not required.
But if you see the second case, the sum total of these other than temporary loans, that is this 50, 60 and 80 is rupees 190, which is more than rupees 170. That means to the extent of 170, special resolution is not required. But for that 20, which is going beyond 170, we need a special resolution. So in real world, whenever you audit a private company, please doubly check whether any borrowings are there, which in most of the cases are there. And if borrowings are there, please check whether when these borrowings were made, any default was there or not in annual filing. I repeat and emphasize, whether on the date this borrowing was made, date of borrowing we need to check. On that very triggering point, whether any default was there or not. So it does mean if I am going to borrow from Punjab National Bank or any bank today, and it is a term loan that is beyond 36 months, then if annual filing default is corrected, that means I made my annual filing, then I again will become eligible to avail the exemption given by section number 181. I believe this point is clear to each one of you. So what I was trying to emphasize, people are okay with 181C, but most of the population is oblivion of this 2017 amendment in the notification that this exemption stands withdrawn if there is an annual filing. Moving ahead, other question is about newly incorporated company and subscription money. A very important scenario over here. I put before the house one question, then we will discuss in detail as to what the ramifications would be. So let us take a scenario. It's a small typing error. Let me first of all correct it. It is not RST Limited, it is RST Private Limited. So RST Private Limited was incorporated on 28th of December 2024. The subscribers undertook to bring in rupees 5 lakhs towards the subscription money in terms of Section 10 Capital A of Companies Act 2013. I may recall, Section 10A says if a company is newly incorporated, it needs certificate of commencement, and that could be given only when within 180 days of company's incorporation, the subscription money is brought in by the subscribers. Now the question further says the amount was not received as at 31st March 2025. Here comes question number 1 for the house. Question says company was incorporated on 20th December with a promise that 5 lakh rupees will be brought in by subscribers towards subscription money. But this money was not brought in on 31st March 2025. I need to emphasize one more element over here. In light of Section 10 Capital A, 180 days are not expiring on 31st March 2025. 180 days will expire somewhere in June 26 or 27. That is June 26, 2025. Now, question arises, how should this be reflected in the financial statements of RST Private Limited for the financial year 2425? So this is my question number 1. Whether this 5 lakh rupees of promise needs any reflection in the financial statements of RST Private Limited for the financial year 2024-2025. This is my question number 1. Question number 2 is, what is the auditor's responsibility if we assume like this, the amount was still not received and the audit report was signed on 18 June 2025. Again, be very focused. The 180th day is tentatively expiring on 26 June 2025. And here the question says, the money was not received and audit report is going to be signed on 18 June. That means 10 days early than the 180th day. So what you will report as such? Second question for this, again, the same scenario, but with a change of date. The amount was still not received and the audit report was signed on 18 July 2025. Now be very careful. In the second sub-question, the date of audit report is 18 July 2025, whereas the 180th day expired somewhere on 26 June or 27 June, whatever the counting will come up. So what you will do, how you will report is the question. I believe most of the chartered accountants might be there who must be dealing with the startups who are newly incorporated companies. So this agenda can come up in audit report for that very case. So let us move to the first leg of my discussion. Company was incorporated on 28 December 2024. Let me have one more addition to the question. First of all, we need to ask ourselves, what will be the financial year ending date for RST Private Limited in this question? Whether the financial year will be ending in this question, whether the financial year will be ending on 31st March 2025 or 31st March 2026. So with the interest of time, because we have a very small amount of time being there, so I will not wait too much for the answers. You may recall we have section number 2, clause 41 of the Companies Act. Section 2, clause 41 of the Companies Act defines financial year. I will show on the screen in a while, but let me say it orally like that. Now, what section 2, clause 41 says, if a company is incorporated on or after 1st January, its financial year will be ending on 31st March of the next following year. In this question, hence, because the company is incorporated on 28 December 2024, the financial year will be ending on 31st March 2025. Now, if financial year is ending on 31st March 2025, the question itself says that this rupees 5 lakh was not received even on 31st March 2025. So whether this needs any presentation or disclosure in notes to accounts or not, financial statements or not, answer is a big yes. You may take a note of a section number 2, clause 64. Section number 2, clause 64 of Companies Act defines paid up capital. And by going that definition, this 5 lakh rupees, which the subscribers promised to bring in, is deemed as paid up capital. That means this 5 lakh rupees will be reflected as paid up capital on the equity side of my balance sheet, irrespective of whether you are into Ind AS or AS. I'm not going into that, but it will come as paid up capital. Now, if we pass this journal entry, the journal entry will be in the blanks account debit to paid up capital account. That means my other question. Paid up capital is okay to be, but what will be in debit side? So in debit side, the nomenclature could be like this: subscription money receivable account debit. Subscription money receivable account debit to paid up capital account. Now another question arises: subscription money receivable, whether it will be reflected as a current asset or a non-current asset. So because it is going to be received within 180 days, which are tentatively expiring on 26th of June, so that means it will be current asset.
Current asset.
Again, a question arises now. If it is into current asset, then which subheading? Trade receivable or something else? So it will be other current asset. So I believe journal entry is clear and presentation classification is also clear. Now, when it will be shown as other current asset, half of the battle is completed because financial statements are now complete. In notes to accounts, management will also disclose that this amount is going to be received in light of section 10 capital A. Now, we always learned that auditing begins where accounting ends. So accounting stands completed over here. Now let us come to the auditing side. The question says, Mr. Auditor, the amount was not received and you're going to sign the audit report on 18th of June. Now, auditor and management sat together and a question came up to the mind. 180th day is yet to arrive on the date of signing of audit report in case number 1. The date of signing of audit report is 18th June over here. So at least the auditor cannot say there is a contravention. I repeat and emphasize. At least the auditor cannot say that there is a contravention because 180th day is yet to arrive. So at least he will not qualify because there is no contravention. If he will not qualify, then what he should do? Should he remain silent? The answer is no. It is a very fundamental matter. It's a fundamental matter. And it's a fundamental matter which is already disclosed in notes to accounts, but warrant no qualification. So what we have to do as auditors, emphasis of matter paragraph. SA, Standard on Auditing 706. So auditor will emphasize this matter. For example, the language could be, we draw the attention to note number X of notes to accounts regarding subscription money receivable in pursuance of section 10 capital A of Companies Act 2013. Since on the date of signing of audit report, 180th day is yet to arrive, our opinion is not modified on this matter. Now, up till here, story may still seem simple, but the complication arises when we change the date of signing of audit report. The date of signing of audit report is, let us assume, 18 July 2025. Now, what is going to happen? Because on 18th of July 2025, auditor and the management both are certain about one thing, that money has not come into the books of company. That means section 10A stands contravened. And section 10A states that you have to receive the money within 180 days of completion and incorporation. So one thing which we believe that, which we are on a common page, that will qualify the report, will qualify that section 10A stands contravened. Qualification will happen. But in addition to qualification, whether anything else is also required. Whether the audit report stands concluded merely by qualifying that section 10A stands contravened.
We have to show the impact of what is the assets are understated, overstated. I mean, every adverse opinion qualification is followed by, yeah.
So now the question arises, if we will give the impact would be that 5 lakh rupees of impact is coming. Is there any other impact which is missing by auditors? Answer is a big yes. I would request the audience to take a note of one more section. Section number 248, very popularly called as striking of the name of company section. Section number 248, subsection 1, clause D. Section 248, subsection 1, clause D says, if section 10A stands contravened, then ROC has the powers to strike off the name of the company, subject to obviously opportunity of being heard. That means ROC may send you a show cause notice, and depending upon the representations, the name of the company may be struck off or may be surviving. Meaning thereby, as on 18th of July 2025, the section 248(1)D stands triggered. ROC may or may not send the show cause notice. That means going concern now became uncertain. So here comes another catch. If going concern became uncertain, then we do have an auditing standard SA 570, going concern. Management needs to disclose this fact in the notes to accounts. And if management discloses this fact in notes to account that going concern may become uncertain because of this whole agenda of section 248(1)D, then if management disclosed it properly, then what auditor will do? In the audit report, a separate paragraph will be given by the auditor material uncertainty about going concern. But if I assume otherwise, this fact was not properly disclosed in the notes to accounts, then auditor will qualify the report for going concern. So for this, I will not stretch my speech. You may have a fact check with SA number 570, which guides you how to qualify or how to give a paragraph about going concern. And in my experience, what I have observed, people are not commenting upon the going concern. They're merely commenting upon contravention of section 10 capital. I also experienced that this rupees 5 lakhs was disclosed only in notes to accounts, but was not reflected in the balance sheet. And what is required? It needs to be presented in balance sheet also, and it needs to be explained in notes to accounts. So I believe this question must be a brainstorming question for each of the listener. So in the times to come, when you will do the audits of private companies, especially the new companies, these mistakes will not happen. And this is the definition of financial year and the requirement of section 10 capital A, which I already discussed. So I will proceed without investing time over here. Let us discuss about applicability of company's audit report order vis-a-vis small company. Before I discuss the theory, let me give you two questions. This is your question number 1. And after this question number 1, I will give you question number 2. To take 30-40 seconds and tell me whether this question number 1, CARO is applicable or not. I emphasize CARO is applicable or not on XYZ Private Limited for the financial year 2024-2025. Whether for the financial year 24-25, CARO is applicable or not on XYZ Private Limited, whereby I am assuming that CARO was applicable in the last financial year. I have seen, maybe because of overlooking or maybe because of negligence, it happens at times that CARO was not applicable in the current year, but was applicable in the last year. And due to that mistake, the CARO report was prepared even for the current year, despite the fact that CARO was not applicable. I must emphasize applicability of company's audit report order needs to be evaluated for each year. We need to come out of the impression that CARO, once applicable, always remains applicable. No, it is not like that. We have to check for each year. And in this case, if I assume that CARO was applicable on XYZ Private Limited for the financial year 2023-2024, please tell me whether it is applicable even for 2024 and 2025. The same thing I must put for question number 2 also. In question number 2, if I assume that CARO was applicable in the last financial year 2024, whether CARO is applicable or not for 24-25. So let us come to question number 1 first. Your call whether CARO is applicable or not. And if applicable, then the reason. If not applicable, then the reason. Kintanji, any answer from the audience?
1 second. The broadcast is delayed by around 40 seconds. So the audience will take at least a minute to respond.
So people, what we need to see, whenever the question comes for CARO's applicability, before I show you the conditions, always first check whether the given private company is a small company or not. If the given private company is a small company, then CARO is not applicable, whatever other data is here. So let us discuss this thing in a detailed way. Normally, what conditions are there for private companies? The company's audit report order says that CARO is not applicable to a private company if all these 4 conditions are fulfilled. If you see all what I am using. So if the answer to all these 4 questions is yes, then CARO is not applicable to private company. What are these conditions? Condition number 1, such private company shall not be a subsidiary or a holding of public company. The words are public company. Then second condition is the paid up capital and reserves and surplus on aggregate basis shall not go beyond rupees 1 crore as at the balance sheet date. So if I assume that balance sheet date in our context is 31st March 2025, so as on 31st March 2025, the sum total of paid up capital, reserves and surplus shall not go beyond rupees 1 crore. Third condition, total borrowings from banks and financial institutions. So all the borrowings are not covered. Only 2 borrowings are covered, borrowings from banks, and second is borrowing from financial institution. That means if you have taken loan from, let us say, PNB, and you have taken loan, let us say, from G Capital, that is NBFC, both will be aggregated. So, but they say total borrowings from banks and financial institutions shall not go beyond rupees 1 crore at any point of time during the financial year. So, if I go by my data, as on 31st March 2025, you have to check whether from 1st April 2024 to 31st March 2025, at any point of time, whether this amount of borrowing exceeded rupees 1 crore or not. If it exceeded, that CARA will become applicable. Fourth condition is total revenue, including the revenue from discontinuing operations, which is reflected in Schedule 3, shall not go beyond rupees 10 crores. Mind you, this limit is 10 crores, not 1 crore. So revenue shall not go beyond rupees 10 crores for the current year, that is 31st March 2025. So if all these conditions are fulfilled, then CARA is not applicable to a private company. When we move forward, CARO also says that I am not applicable to a small company. So, but CARO has not defined what is small company. Small company is defined by section number 2, clause 85, the limits of which were revised on 15th of September 2022. Now, what the law says, if I read section 2, clause 85 of the Companies Act, with rule 2.1t of company's definition rules, what it says, who is a small company? It's a company having paid up share capital of up to rupees 4 crores and turnover as per preceding year P&L up to rupees 40 crores. Earlier, this limit was 2 crores and 20 crores, which now then was revised in September 2022. The law further says following companies are not a small company: public company, holding or subsidiary company, section 8 company, company or body corporate governed by special act. If you see, private companies are not mentioned in A, B, C, D. That means we can conclude very safely that only a private company can become a small company. So if there is a private company and its paid up share capital is up to rupees 4 crores and turnover of the last year P&L is up to rupees 40 crores, and it will become small company. With this very agenda of discussion, let us come back to question number 1. Now please check whether CARA is applicable here or not. First of all, check whether this XYZ Private Limited is a small company or not. The very moment you will say it's a small company, we would be very easy to say that CARA is not applicable. So whether it's a small company or not.
Yes, XYZ, since the capital is not exceeding 4 crores and the turnover is not exceeding 40 crores, it seems a small company.
Okay,
So
before I
24,
give my
25.
conclusion, I will go to question number 2. Please check here in question number 2 whether there is a small company or not. So in question number 2, whether XYZ Private Limited is a small company or not. I believe the same answer, that it's a small company.
Yeah, it seems very fair that in question number 2 also it's a small company, but in question number 1, the company is not a small company in 23-24. So yeah.
So what we need to understand, in general, this again happens in real world. The definition of small company needs to be minutely looked out. If you see the words used in section number 2, clause 85, what they say paid up share capital, and then the words use a turnover as for preceding year P&L. That means for the purpose of evaluating whether a given private limited company is a small company or not, you will take paid up capital of the current year, but turnover of the preceding year. If I go by that virtue and apply this in question number 1, the current year paid up capital is 48 lakhs. It is far below than rupees 4 crores. But when I see turnover of the last year is 44 crores. That means in question number 1, XYZ Private Limited is not a small company. Now, when we concluded that it is not a small company, then what we will do? We will check the applicability of CARO on the basis of these general conditions, these 4 conditions. When I apply these 4 conditions in my example, first condition is this XYZ Private Limited shall not be a subsidiary or holding of a public company. The question is silent, so we can safely say that it is a standalone company. Condition number 2 was the sum total of paid up capital reserve surplus shall not go beyond rupees 1 crore. This condition is also fulfilled, 53 lakhs only. Third condition was its borrowings from banks and financial institutions at any point of time shall not go beyond rupees 1 crore, but it is now 3 crores. So borrowing condition is not getting satisfied, and that's why what will happen? CARO will become applicable. Even if, for the sake of academical debate, I say that borrowing is zero, even then CARO will become applicable because the total revenue is more than rupees 10 crore. So in this question number 1, CARO is applicable on XYZ Private Limited because it is not a small company and its borrowings, or as the case may be turnover, I should rather say total revenue, exceeds the prescribed thresholds of rupees 1 crore and 10 crores respectively. But when we move to question number 2, only one change I made, that 44 became 34. So current year paid up capital is 48 lakhs, which is again less than rupees 4 crores. And last year turnover is 34 crores, which is less than 40 crores. Meaning thereby this XYZ Private Limited hence becomes a small company. A question arises whether it's a small company, yes. Whether CARO is applicable, answer is no. Why the answer is no? Because the company is a small company. Now a confusion may come up. The confusion is, shall we say and proclaim that CARO is not applicable to XYZ Private Limited because it is a small company? Or shall we say that CARO is applicable on XYZ Private Limited because it is a private company whose borrowings or turnover, total revenue, exceeds the prescribed threshold of rupees 1 crore or 10 crores as the case may be. So very simply saying, once a company qualifies small company, other conditions which are called as general conditions need not be checked. CARO will not be applicable. You may take a note. Para number 12 of Guidance Note on CARO 2020 issued by Institute of Chartered Accountants of India has very specifically written over there that once a company qualifies as small company, the general conditions need not be examined. But here is a caveat. The caveat is, if you are the auditor of XYZ Private Limited and CARO is not applicable on account of it being a small company, you may recall in the audit report we have a separate segment reporting under other legal and regulatory requirements. So in that segment, reporting under other legal and regulatory requirements, we have a separate pointer on CARO reporting. There we write that CARO report is given in annexure number so and so. That point needs to be replaced. It will be substituted with a new point or a new para whereby you will be writing, on the basis of information and explanation given to us, we report that CARO is not applicable on XYZ Private Limited on account of it being a small company under section number 2, clause 85 of the company. So if CARO is not applicable on a private company because it's a small company, you will mention this fact in the audit report. So I believe this point is clear to all of the listeners. If there will be doubt, we may take up at this point of time or maybe at a later stage. But the point here, which I must again reiterate with very more emphasis, please check each year whether CARO is applicable or not. Because if CARO is not applicable and CARO is reported upon, it will be a professional misconduct under chartered account. Let us proceed further. Share application money. Again, from my experience, there is a discussion on agenda of share application money, which people at times commit a mistake into. So before I discuss that mistake and scenario, I place before the house one case study again. Assume that the company is RST Private Limited, and this is the extract of the balance sheet. RST Private Limited says that it received share application money of rupees 1 crore or 100 lakhs through normal banking channels on 15 January 2024, and this share application money was pending allotment as on 31st March 2024. Amount is 100 lakhs or 1 crore. The question also depicts that this amount remained outstanding as it is even on 31st March 2025. So share application money which was received on 15 January 2024, which remained outstanding even on 31st March 2025. This is the balance sheet which I placed before you in your capacity as statutory auditor. What auditing aspects you will keep in mind in this kind of a scenario? Now listen. Point number 1, you may take a note. We have rule number 2, sub rule number 1, clause C, sub clause 7. 7 is a Roman 7, V11. I repeat, rule 21C7 of company's acceptance of deposit rules, what it say? The rules say that if a company has received share application money, then this share application money shall be allotted within 60 days of its receipt. If the allotment is not so made, then this money shall be refunded
15
within
days.
next 15 days.
Yeah.
If it is not so refunded within this overall time span window, 75 days or so, then this money shall be considered as, now listen my words, deemed deposits. That means this money which remained outstanding even as on 31st March 2025 is now in the category of deemed deposit. Now, the law says, if you refer companies acceptance of deposit rules, chapter 5 of the rules basically, it says it became deemed deposit, okay. Now, don't you think that this deposit has a clause to be reported in CARO? Answer is yes. If CARO is applicable, in company's audit report order, we have para number 3, clause number 5. Para 3 subpara 5, I should say rather, para 3 subpara 5 of CARO states that auditors have to report whether the provisions of section 73 to section 76 of Companies Act have been complied with or not. Now, this falls into section 73. So, because it became deemed deposit, which was accepted without the compliance of the deposit rules, it needs a reporting in the CARO on account of contravention. And if I assume otherwise, that CARO is not applicable, if I move that way also, it warrants a qualification on the face of the audit report that company deposit rules are not complied with. So it warrants a qualification via CARO or without CARO, that depends upon case to case. What is the contravention? Rule 21C7. Moving a step ahead. Is it a liability as on 31st March 2025? Yes, it's a liability as on 31st March 2025. We need to check whether this liability is properly provided for or not. And for this purpose, again, we need to go into Companies Act. We do have section number 42. We do have section number 42, subsection number 7. What it says that if share application money is not refunded as required by the rules, then you have to pay interest also. You have to pay interest also. Just see. Sorry, section number 42, 7. It should be 7, not 6, 12% per annum. So what is the requirement? That on this 100 lakh of rupees, which is here, you have to pay interest also. Just see the wordings. If the company fails to repay the application money within the aforesaid period, it shall be liable. The word is shall. That is, you have no option. We have to pay. You have to pay the interest, and that the rate is given 12% per annum. Now, as auditors, we must be on the alert mode. The alert mode is your company, RST Private Limited, may be either into accounting standards or be in the Ind AS, as the case may be. By virtue of Accounting Standard 29, which deals with provisions, contingent liabilities, and contingent assets, or if I go to Ind AS 37 on the same title, we need to check whether the provision for interest payable is provided or not on this 100 lakh rupees. And what is the quantum? 100 lakhs multiplied by 12%. Are you getting my point, Kintanji? So this interest payable provision is also required. And if it is not so made, then quite obviously qualification with the impact that expenses are understated or provisions are understated. This is not the end of story. Up till now, we only understood deemed deposits and reporting thereto under CARO. We understood about interest provision. See this question again from the eagle's eye and ask yourself, is any other thing also required to be reported? I can give the hint whether in this question, director's disqualification is visible. Is there any director's disqualification? I may recall you why I am asking this question. We do have section number 143, subsection 3, clause G of the Companies Act. Section 143, subsection 3, clause G of the Companies Act requires the auditors to report as to whether any of the director is disqualified or not under section 164(2) of the Companies Act. Are you able to recall? Section 143(3) says auditors have to report, and it is applicable to both public companies and private companies, whether any director is disqualified or not under section 164(2) of the Companies Act. Now you may recall, section 164(2) is having two sub-clauses, clause A and clause B. 164(2)A says disqualification will be retracted if there is an annual filing default. for 3 continuous financial years.
Hmm.
And then clause B says disqualification be attracted if the default is being made in repayment of deposits. Other things are also there: deposits, preference, dividend, etc., etc. Now, the due date is more than equal to 1 year. So if you made a default in repayment of this amount for more than equal to 1 year, which in my case is happening. So as on 31st March 2025, 1 year has elapsed from the due date which arrived on 31st March 2024. That means directors are also disqualified. I repeat, directors are also disqualified. And if directors are disqualified, Chintanji, just see kind of reporting which is getting missed.
Yes.
People are reporting on the basis of written representations received by us. None of the directors is disqualified. But the balance sheet itself is telling a story. The directors are disqualified. So meaning thereby we need to be very cautious. Do not write that on the basis of written representations received by us, directors are not disqualified, because the balance sheet is telling a contradictory story. The directors are disqualified. And that's why this question assumes a special significance. So in this question, we had 3 learnings primarily: deemed deposits, interest on such deemed deposit, that is 12% per annum, and then directors disqualification. That is this thing. So I discuss 164(2)(b), this one. Repayment of deposits, interest thereon, debentures, interest thereon, dividend for more than equal to 1 year from the due date. So please be very careful to capture all these nuances when share application money is there. And I discuss CARO as well. So in para 3.5, we need to report about deposits provisions to be complied or not by the company, section 73 to 70. So I believe this question must be a brainstorming question to the listeners, and you must have understood the gravity of share application money being there in the balance sheet.
In the current case, Kamal sir, on 31st March 24, 60 plus 15, 75 days are exactly completing on 31st March 24. So it's a
Yes.
default for both the years or just 25?
It is got of both the years.
Both the years.
So what will happen in 24? Because exactly 75 days are happening
Yes,
and the due date has arrived.
arrived.
So some people may take a very liberal stance ki due date came today itself, so we can pay tomorrow. So directed disqualification may still be on a very, I should say, lenient side,
Inside.
because 1 day is not a very big day for that matter per se. Because
But it's a deemed deposit as on 31st
But
March.
yes, it's a deemed deposit.
And also it should be followed with a filing in DPT3 as well.
Yes, yes, yes,
Yes.
100%.
Right.
And by your words, another point came to the notice of listeners, I believe, that we have to also check whether DPT3 is capturing this deemed deposit or not.
Which is due on 30th June of next financial year.
Yes. Now CSR. Again, I will move with the same things with a case study, but for your convenience, let me give a theory first. CSR applicability says, section 135, subsection 1. The CSR provisions are applicable to every company which in the last financial year fulfills any of these 3 conditions. So as on 31st March 2025, you will check whether for the financial year which ended on 31st March 2024, any of these conditions were there or not. Net worth more than equal to rupees 500 crores, turnover more than equal to rupees 1000 crores, and net profit more than equal to rupees 5 crores. Before I discuss in detail, I place before the house an extract of profit and loss statement. This is the extract of profit and loss statement for the year 23-24, and the figures are given in crores. Take this data for your analysis and tell me, with the help of this data, whether CSR is applicable or not in the year 24-25, because this is the subject matter year for our context. So on the basis of this data of 2324, you need to tell me whether CSR is applicable or not for the year 24-25, because the law says you have to take the past year data to evaluate the CSR applicability for the current year. So current year in my question is 24-25. So if I put the question in a different way, the question would be, section 135(1) says, if the last year net profit is more than equal to rupees 5 crores, then CSR will become applicable. You simply tell me in this question, what is the amount of net profit for the purpose of section 135(1) evaluation?
So we start with PAT 3 crores, and we should add back provision for bad debts around 1 crore. And I'm not sure about unrealized fair loss on investments. Uh, so if we add it as well, so we are on the brisk of the breach threshold of 5 crores. Apart from that, yeah, but also one important thing is we have to start from profit before tax and not profit after tax. So
Yes,
we have to
MC
start
circular
from
is there. MC circular is there of 2014. You have to start from PBT.
PBT. So we start from 4 crores. We add provision for, as per section 198.
You have captured the nerve, sir. I was eager to listen section 198. So you have captured the nerve. So Kintanji, my experience had been generally people are taking net profit for the purpose of spending on the basis of section 198. But net profit as per face of the P&L for the purpose of CSR applicability. Are you getting my point? I repeat, when it comes to evaluating whether CSR is applicable or not, people are taking this PBT as such without any adjustments. But when it comes to spending 2%, they do compute section 198 scenarios, which is wrong. Because for the entire section 135, net profit shall be computed as per section number 198. Explanation below section 135 very categorically says, for the purpose of this section, net profit shall mean as per 198. Now, although we have MC circular of year 2014, which says that you have to start with PBT, if I assume that that circular is not there, let us assume that way, doesn't make a difference because section 198 will be looking after all the things. If I start with PAT also. Now what section 198 says, how to compute net profit under section 198, it says take PAT, add back unrealized fair value loss, and it had been gain, then we would have correspondingly made otherwise adjustments. Section 198 further says that add back provision for bad debts. Actual bad debts are allowed, but provision for bad debts is disallowed. So we'll add this back. And section 198(4) says that add back income tax expense also. So even if I assume that MC circular had not been there, doesn't make a difference. So what will happen now? If I aggregate this addition, 3 plus 1 plus 1 plus 1, it will be exceeding rupees 5 crores. So 3 plus 1, 4, 4 plus 2, 6. So it is going beyond 5 crores and hence CSR is applicable. So as auditors, I would suggest you, when you audit any private company, especially those private companies whose net profit is near to 5 crores or 6 crores, please check. Because in my example, deliberately, I am saying that profit is touching 5 crores. It may happen otherwise also. That 6 crores of profit in face of P&L may come to 4 crores after adjustments. Both ways it is possible. CSR was applicable but was not made applicable because of wrong calculations, or CSR was not applicable but was made applicable because of wrong calculation. And why this is important to understand, because as I told, explanation to section 135 says, for the purpose of this section, see the word this, for the entire global section of 135 we discover. For the purpose of this section, net profit shall not include such sums as may be prescribed, which I have not discussed because this is not the agenda, and shall be calculated in accordance with provisions of section 198. As Kintanji rightly replied my question, adjustments are required even for applicability portion, not only for spending portion. Now, if we assume that CSR is applicable, please try to resolve another question on the basis of this theory. What the law says, section 135(5) says if CSR is applicable, then company needs to spend at least 2% of average net profits of last 3 financial years. This is what the question says. How to compute this average? If you read minutely, Companies Act has not told us how to compute this average. So we need to apply mathematical logics when we compute average. It's not always a simple average. To make my point clear, I place before the house one small question. And why this question is important, which I'm going to show. In CARO, we have to report. In CARO, we have to report about CSR. whether spending was proper or not. And if CARA is not applicable, otherwise we have to report on the face of the audit report. Compliance section 135. So please take this data and tell me from the basis of this data, you may take a minute or so, take this data and tell me what will be the amount of spending required for this company XYZ Private Limited. So what the data is, XYZ Private Limited was incorporated on 5th January 2021. Compute the spending for the purpose of CR on 31st March 2025. Basis this data. Net profit for first financial year 60 crores. Net profit for second financial year 80 crores. Net profit for third financial year 100 crores. We may assume here that this net profit is as per section number 198. So assuming that this profit is computed as per section 198, please tell me for XYZ Private Limited, what will be the 2% spending for the financial year 24-25?
The first subclause net profit for the first financial year 60 crores is financial year 21-22. Year ended 31st March 2022. Is that right?
Sir, I will disclose the answer in a while.
Yeah.
Let me remind, which we discussed in a previous question for newly incorporated company as well. What section 2 clause 41 says, Kintanji? If a company is incorporated on or after
First of
January,
yeah,
then its financial year will be ending on 31st March next year.
next year.
So now in this question, company got its incorporation on 5th January 2021. That means its financial year, that is the first financial year, will be ending on 31st March 2022, which is absolutely perfect, you told me.
Yes.
Now on that very basis, I need the answer from audience. What will be the 2% spending? And Kintanji, you will get to know, or you must have also experienced this thing in the real world. This is one of the area where calculation mistakes are happening. Somewhat fortunately, this agenda may not come to the table of ROC. In times to come, it may come up.
Kamal sir, can you come to the slide before,
Yeah.
if it is possible? Yeah.
So let me show the solution so that the time could be saved. Basically, Kintanji, what is happening in real world, this average is not properly computed. What people are doing a wrong calculation. What they will do, they will compute a simple average. 60 crores plus 80 crores plus 100 crores divided by 3. But being chartered accountants, and I must say being a very layman into mathematics as well, if we are at all, at least average could be properly computed, because if I divide 60 plus 80 plus 100 by 3, it means that the 60 crores of profit is for 12 months, which it is not. And that's why this becomes a wrong calculation. And in this kind of a scenario, we need to compute weighted average. How? Just see here. Financial year number 1, 21-22, which will range from 5 January 2021 to 31st March 2022. 15 months.
Yes.
Net profit 60, so it will be a weighted amount of 900 rupees. Other two ways are simple. Weighted amount will be 960 and 1200 respectively. Sum total will be 3060 and months total will be 39. So weighted average will be 78.46. And then 2% is very much easy to apply. 2% of 78.46, 1.57. Now take a situation. Situation is, if I will not do this weighting, what will happen? 60 plus 80 plus 100 divided by 3. The amount will change.
Yeah.
And then if auditors are not capturing this, adequate spending, auditors will be deemed negligent of the computation, even if you have maintained the working paper. Because in working paper, what your working paper will say? Your working paper will say the wrong calculation. So while you will not be held guilty for non-maintenance of working papers, but you may be held guilty for wrong calculation. So we need to be very careful that this way we need to check whether our clients have properly computed this amount or not. So I believe this point is clear to, I believe, the listeners as well. And in times to come, if this kind of scenario is coming up, the budget amount would be properly computed.
In such a scenario, if there is no clarification from MCA or the Companies Act per se, and there is a debate between the auditor and the management.
I would not say, Kintanji, I would not say it will be a debatable issue because we have SA number 520 analytical procedures and we have SA number 500 audit evidence. If I apply both these harmoniously, mathematical techniques primarily will say that it will be wrong to have a numerator of 15 months and denominator of 12 months. Because I cannot say that 15 months of profit was earned in 12 months.
Yes.
So it will be a mathematically getting illogical.
Got it.
Consider this question. I must give a disclaimer. This is a purely academical question. Why I'm saying academical? Because I have taken the real names. So it is only for the sake of understanding. So let us have this question over here. Companies Wipro Limited. I'm saying it again. It is an academical question for the sake of our understanding development. Now, Wipro Limited is having one Section 8 subsidiary by the name Ajim Premji Foundation. As my question also says, Wipro Limited is holding company of Ajim Premji Foundation. Now, you may recall that we have CSR rules, and CSR rules say that your company can undertake CSR spending activities via implementing agencies, of which implementing agency could be your subsidiary also, provided it's a Section 8 subsidiary. And that's why what Wipro did, Wipro carried out CSR activities and spending through its such a subsidiary. Having said that, the questions are, question number one, what are the accounting disclosures for holding company vis-a-vis subsidiary? Question number second, whether such subsidiary needs to be consolidated with Wipro, irrespective of whether we are into accounting standards or Ind AS. And last question is, what are the audit report requirements under CARO 2020? Because here Wipro is public limited company, so CARO is applicable. Even if I assume Wipro is private limited, we can also assume correspondingly that CARO is applicable. So these are the three questions. Out of these three questions, let us forget first question and the last question. Let us consider second question, whether consolidation is required or not.
Per se, it looks yes, because it's a subsidiary and we are holding 100% of it. So the consolidated financials should reflect this, but yeah.
Okay. Any answer in the chat box people have sent for consolidation?
Let me check. No definite response as such. Yeah.
So people, those who are listeners, please understand consolidation is not required.
Okay.
I will take this question on a much more pragmatic note now. Other two questions are not that much complicated, but this question number second is, please let us understand why consolidation is not required. For this purpose, we need to go into Section 8 first of all. Now, what Section 8 says? Section 8 says that a Section 8 company is not allowed to distribute dividends, is not allowed to distribute profits to the members. I believe this point we all of us know. That a Section 8 company is not allowed to distribute any chunk of profits to its members. Now, if this is the condition or the requirement of Section 8, now let us apply this thing in context of accounting standards and Ind AS. We do have AS 21. AS 21 says a subsidiary will not be consolidated if it operates under severe restrictions, whereby its ability to transfer funds to the holding company is adversely affected. Same way, if I come to Ind AS 110, Ind AS 110 says the parent company will be having no control over the subsidiary company. I repeat, a parent company will be having no control over the subsidiary company if that parent company is having no rights. I repeat, is having no rights over the returns of the subsidiary company. So because Section 8 company cannot give dividends to the parent company, obviously the exposure towards the profits is not there. And that's why consolidation will not happen. And for this purpose, I may buttress my views further. We may recall we have Schedule 3 of the Companies Act. In Schedule 3, we have to give a disclosure in a tabular format about the companies and subsidiaries and associates. If you will check the footnote of that chart, the footnote of that chart says, name the subsidiary which is not consolidated along with the reasons why it is not consolidated. So this could be one of the reasons that section 8 subsidiary cannot be consolidated. And for this purpose, if I spill the beans for all these three questions, I will start with question number second. Whether such subsidiary needs to be consolidated Wipro? Answer is no. Why? Because AS21 or Ind AS 110, as the case may be, what it says, no consolidation where subsidiary cannot distribute profits to its members. And I must emphasize here, this thing you need to disclose by virtue of Schedule 3 also. Now, question number one, what are the accounting disclosures for holding and subsidiary? Please understand, consolidation is not required. But because of no consolidation, the relationship of being party related is not getting extinguished. So for that very purpose, disclosures as per AS 18 and Ind AS 24 will be required. What about CARO? At present, we are into CARO 2020 regime. In CARO, we have to report about CSR compliance, para number 320. And I must also say, not only CSR compliances, in CARO, we have para number 3, sub-para number 13, which requires that you have to report about compliances of RPT. So that will be the scenario. In this question, from my experience, I found that people were diligent for question number 1 and question number 2, but some kind of, I should say, lapses I observed in real life, that people did consolidation where it was not required at all. So I believe this point must be understood by all the listeners. Other question. In one of the P&L statement, I observed this thing. The company incurred CSR expenditure, and the company has disclosed the CSR expenditure under the heading Other Expenses with a subheading CSR expenditure for the year. So you may recall under Schedule 3, the format of P&L is there, and one of the items is Other Expenses. Now what company did? Other Expenses, subheading CSR expenditure was disclosed in notes to account. So is it a right disclosure? Is it the correct disclosure? Please understand, we have guidance note on Schedule 3. And when I say guidance note, it is for all the 3 divisions. Division 1 for AS compliant companies, Division 2 for Ind AS compliant companies, and Division 3 for NBFCs complying Ind AS. You refer any guidance note of any division, one thing is common. Please take a note, the CSR expenditure will be a separate line item. Guidance note here means guidance note on Schedule 3. Guidance note on Schedule 3 says that expenditure on CSR activities shall be recognized as, just see here, should be recognized as separate line item as CSR expenditure in this statement of P&L. So when you will draft P&L, on the face of it, you will insert one more row, a line item, CSR expenditure. And further, you have to provide the breakup of that CSR expenditure in notes to account. So in real world, what was observed, that it was not shown as a separate line item, rather it was shown under the other expenses. So now I believe we may make a correction there too.
This is for both AS and Ind AS, both the companies?
Both for AS as well as Ind AS. That's why deliberately I wrote the word guidance note GN. So GN will cover 1 division, 2nd division, and 3rd division. Next. Inconsistency in notes to accounts and board report. Again, I should say a very big non-compliance which happens at large. Now, what is the non-compliance? Let us discuss. I must give a kind of briefing before I discuss. We have Schedule 3, and Schedule 3 says that you have to disclose in the notes to accounts 2 things, primarily, amongst other things. Number 1, whether the company has transferred any amount of profits to reserves or not, that you need to disclose in notes to accounts. Secondly, notes to accounts you have to disclose whether a dividend is proposed or not. That means Schedule 3 is asking you to disclose appropriation to reserves and dividends proposed, if any. That is what the requirement of Schedule 3 is. Now, as auditors, we have to report upon Schedule 3 disclosures also. This is my first part. Now, second part, director's report. When we come to director's report or board report, we have section number 134. Section 134 of Companies Act says, in the board report or director report, by whatever name called, in the board report, the directors have to report the same thing again, appropriation to reserves, proposed dividend, if any. So, Kintanji, what is happening? In Schedule 3, the private company is not writing whether any amount is appropriated reserves or not, or whether any dividend is proposed or not. So let me say like this, Schedule 3 is altogether silent. Why? Because nothing was appropriated to reserves and nothing was proposed as dividend. But the director's report of the same company is saying that the directors have not appropriated any amount to reserves and no dividend was proposed for the year. Now the reader may get confused that notes to accounts are silent about the appropriation to reserves and dividend proposals, if any, but directors' reports are indicating that nothing such kind of a sort happened. For this purpose, one standard is there, SA 720. SA 720 is applicable to all the companies. And in real world, Kintanji experience had been, people are of the view that SA 720 is applicable only to listed companies. Let me correct. SA 720 is applicable to all the companies, and SA 720 deals with reporting of inconsistencies in audited financial statements vis-a-vis other information. In my context, it is director's report. So just see what I stated. Section 134(3), clause J and K respectively says, board report shall state amounts, if any, which it proposes to carry to reserves, and amounts, if any, which it recommends to be paid as dividend. That is what the requirement of director's report disclosure is there. On the same front line, Schedule 3 also says, in notes to accounts, disclose transfer to or from reserves, if any, and amounts of dividend proposed, if any. So if this is not disclosed, Schedule 3 disclosures are not there because private company may not have done this thing, but in director's report you're writing it compulsorily, then this may result in inconsistency. And if this inconsistency is there, as per SA number 720, you have to report like this. So you may download SA 720 from the website of ICAI, and you may have a look on this. This is illustration number 4 of SA 720, and you may take the format of reporting from that place. But I am emphasizing what to report. This first paragraph is important. What you will report, just correlate with my words. In the audit report, a separate heading will come up as a caption, other than financial statements, that is other information paragraph. And below this other information paragraph, what you will be writing somewhat like this: the company's board of directors is responsible for other information. The other information comprises the director's report, but does not include financial statements and our audit report thereon. The director's report is expected to be made available to us after the date of this auditor's report. This is one of the sample reporting. It may undergo a change depending upon your requirements. So my suggestion is download SA 720, and there are certain illustrations for probable reporting. Use those illustrations as per your requirement, but please do not leave this kind of reporting from your audit report. So in a single liner, I would say SA 720 reporting is required in respect of inconsistency in notes to accounts vis-a-vis the board report. And this standard SA 720 is applicable to all the companies. So this is the scenario which I stated. Check and document the relevant minutes of the board meeting. Corroborate whether any dividends are recommended or not. If not, then check whether notes to accounts mention the fact, and so on. This is not a case study per se, but this is the kind of observation made by NAFRA, National Financial Reporting Authority, for board resolution approving financial statement. NAFRA issued this order on 12th of April 2023, and what NAFRA stated that if we go to companies that we have section number 134.1, and in section 134.1, the requirement is that financial statement needs to be approved by the board. That is what the requirement of section 134.1 is. Now, what NAFRA stated by its order, you can see the title of this slide, NAFRA's order. By this order, NAFRA stated that auditors shall have to obtain a certified copy of board resolution. What board resolution I am talking about? This board resolution, section 134.1 resolution. So if you are auditing the private company this time, please ensure that you must have in your audit file a copy. And what copy? Certified copy of the board resolution for approving the financial statements of the given year, that is 24-25. Now, company under CIRP. So you may come across a private company which is undergoing corporate insolvency resolution process by virtue of insolvency and bankruptcy code. So I will not go into what CIRP is or what IBC is, because I believe we are mature enough to understand what this is all about. I straightforward come to a case. So let us assume the company is RST Private Limited and it is undergoing CIRP, that is Corporate Insolvency Resolution Process. Mr. X is appointed as insolvency professional for RST Private Limited. As we may recall, under IBC, the provision says once the company goes into CIRP, the directors are suspended. So if I assume that 3 directors were there, Mr. R, Mr. S, and Mr. T, so all these are suspended directors, and hence the question, whether the financial statements, FS means financial statements, whether the financial statements of RSC Private Limited need to be signed or not, by these suspended directors. Yes, any answer? So whether these RS and T, because minimum 2 directors are required to sign the financial statements in normal cases, so whether these signatures are required or not from the suspended directors in such a case. Yes, any answer from any of the listener? This is again I will not say it's very prominent point in the real world, but whenever there is a case of companies going on CIRP, this could be one of the area which, as auditors, we need to be very careful about. So, people, we have a judgment of NCLAT, National Company Law Appellate Tribunal, in CLC Industries case, and NCLAT held that signatures are required because directors are suspended from their powers, not from the duties. And one of the duties is to sign the financial statements, and that's why just see this case law. Yes, they have to sign. And clad in the matter of Mukund Chaudhary versus Subhash Kumar Kundra. Popularly, this is called as CLC Industries case. It was held that the signatures are required. Why? The logic given by NCLAT was that they are suspended from their powers, not from the duties. The duties remain intact. And that is what we need to understand in a very careful manner that yes, this kind of scenario, if at all comes to your being, please be careful to ensure that the copy which we are going to receive regarding this board resolution, it must also bear the signatures along with the insolvency professional, plus the financial statements must also be signed. Next, internal controls over financial reporting vis-a-vis small company. Now, what is small company? We already have understood. Now, what is the point here? We do have section number 143, subsection 3, clause I. It says that auditors have to report on internal controls over financial reporting, which is very popular section nowadays. But we have exemption notification also. So exemption notification was issued originally in 2015, and then it was amended in 2017, which you can see the notification number here, 2015 and 2017. Now, what the notification says as on date, the notification says as on date that this internal controls over financial reporting, need not be made by the statutory auditors, of the following private companies. Number 1, OPC, that is 1% company. Number 2 is small company. To this, I believe things are comfortable. The real challenge comes up in this case, private company. Now, what the law says, auditor of a private limited company need not report on internal controls or financial reporting if this private company has a turnover of less than rupees 50 crores as per latest audited financial statements. So in our context, it will be 31st March 2024. And I will come to this word and again. And so both are cumulative conditions, both need to be fulfilled. And number 2, aggregate borrowings from banks or financial institutions or any body corporate at any point of time during the financial year is less than rupees 25 crores. So the signs are less than. Now, what is the bone of contention which we need to understand? So, Kintanji, in real world, a very big mistake happens. This amount of 25 crores is not properly computed. People generally, I should say, overlook this body corporate. They will include bank overdraft. They will include loan from NBFC because every borrowing is covered here. There is no specification about long-term borrowing, short-term borrowing, CC, or working capital. Each loan is covered. But this loan is not only from banks and FI, but from body corporate also. So there could be scenario, there could be intercorporate loan. So if in the balance sheet of a private limited company, intercorporate liability is there, that will also be captured because any body corporate words are there. This is number 1. There is another confusion, whether this is and or. So Kintanji, what happened when this June 2017 notification was given? The word was or. The word was or. Then in July 2017, that is immediately after this June 2017, in July 2017, one corrigendum notification came up. And in that corrigenda, the word or was replaced with the word and. So as on date, we are far behind now this whole agenda. We are fast forward. It is now and. Or has no place. So if both these conditions, A and B, are fulfilled, then statutory auditor of this private company need not report upon internal control over financial reporting. With this very background, I place before the House this case study. You have to tell me whether internal controls over financial reporting is applicable or not on RST Private Limited for the financial year 24-25. If the data goes this way, its current year turnover is 45 crores. Figures within the bracket means last year 40 crores of the last year. Borrowings for the 24-25 is given to you. PNB overdraft after 50% repayment 5 crores. Loan from NBFC GE Capital 2 crores. Loan from XYZ Private Limited, its subsidiary, rupees 5 crores. Loan from ABC Private Limited, which is a party unrelated, rupees 9 crores. So whether ICUFR is applicable or not in this case of RSC Private Limited, for your assistance, you may have a relook on the conditions. And be very careful. Turnover here is as per latest audited financial statement, so it will go back to the previous year. But the borrowings are for the financial year, that is the current financial. So this is the numerical data on this basis, whether ICUFR is applicable. So in the interest of time, let me resolve.
The total of borrowings comes to around 26 crores, I think.
Yes, 26 crores.
Yeah.
So see, the latest turnover of the last year data is rupees 40 crores, which is less than 50 crores. So this condition stands fulfilled. If I compute the total borrowings, including body corporate, it will be 26 crores. You can see 10 crore from PNB, 2 crores from NBFC, 5 crores from XYZ, and 9 crores from ABC. It is 26 crores. Now, this 26 crores is more than rupees 25 crores. And that's why ICFR is applicable. In real world, what I experienced, these 5 crores and 9 crores were not aggregated. Now, the very moment the body corporate borrowings are kept outside the whole agenda, it will be only 7 crores. Sorry, not 7 crores. This will be only 10 plus 2, 12 crores. Why this is 10? Because the words were at any point of time. So this amount of 5 crores is after repayment. Na? At any point of time is before repayment. So it will be grossed up 10 crores. So imagine a situation, what kind of mistake can take place if you will not aggregate this 5 crores and 9 crores with this loan. Wrong conclusions will come up that ICFR is not applicable. But the words were body corporate, and that's why in this we have aggregated these two components as well. And accordingly, the conclusion stands corrected. The ICFR is applicable. This is the question which I was very much eager to discuss. And in my initial remarks of this speech, I asked you whether a private company can accept deposits from the members. So this is my last discussion, which I will be taking with you. Post that, I will be taking the questions from the audience. So let us discuss this of all. But before I discuss, question is the same: whether private company is allowed to take deposits from the members. For the sake of convenience, you may use the word shareholder also. The normal people believe that a private company can obtain deposits from the directors and the relatives. But whether members are also there to stand with you to give you the amount of deposit? So people, be very careful what you are going to see now. Answer is a big yes.
Yes.
Private companies are allowed to accept deposits from the members. But what are the conditions? Let's have a look out. We have rule number 3, sub rule number 3, proviso to rule 3.3 of companies acceptance of deposit rules. What the proviso says, a private company is allowed to accept deposit from the members, but this is the lookout. Number 1, it accepts deposits from the members but the threshold is given. It shall not exceed 100% of paid up capital, reserves and securities CM account. So this is the limit given. That is that your amount from members towards deposits cannot go beyond 100% of your core capital. And please be careful. The similar wordings were almost there in section 181C also. When you remember borrowing power for private companies. Now, this is the threshold being given, but for other two clauses, threshold is not applicable. That means you can even go beyond this core capital. Maximum threshold is not applicable. For whom? For a startup company. But this benefit is available only for 10 years from the date of incorporation. So proviso to rule 33 says if you're a startup company, you can accept any amount of any quantum from your members, and there will be no contravention, but this benefit is given to you only for a limited time frame, that is 10 years. Other, a private company, if it fulfills all these three conditions, then such private company can accept the amount of deposit without examining this 100% threshold. And what are these conditions? Such private company must not be an associate or a subsidiary of any other company. So private company, public company, both are covered. You must not be having any kind of subsidiary holding status or associate holding status. Number second, such private companies' borrowings from banks or financial institutions, now be careful again, body corporate, shall be less than rupees 50 crores or twice the paid up capital, whichever is lower. And such private company has not defaulted in repayment of such borrowings subsisting at the time of accepting such deposit. So if I am accepting deposit today and till yesterday there was a default, if I correct the default today, then I have again a benefit of this notification. That is proviso to rule 33. So being thereby, if you comply this clause A, B, or C as the case may be, private companies are allowed to accept deposits from the members. Now, without searching on Google, please answer my two questions which I am writing on the screen. The questions for you. This is my question number 1. Whether members who give deposits to the company also need to give declaration that this is their own money and not borrowed money. This is my question number 1. And then I have one more question. Whether company needs to make any administrative nature compliances for accepting deposits. So you may ignore this question number 2. I will discuss question number 2 separately, which is not a very big deal, but question number 1 is important. So for example, generally it is a kind of understanding that if a private company is accepting deposits from the directors, then you need to obtain a declaration from them that the funds being provided are directors' own money and not the borrowed money. Whether this understanding also applies when you accept deposits from the shareholders or members.
I think in the acceptance and deposit rules 2013, which are updated, this condition of borrowed money is only for directors and it is not for shareholders. This is to the best of my knowledge. Yeah.
So people, please take a note. We have rule number 10 of deposit rules. And as auditors, you have to check it. What it says, this rule number 10 says, I am writing some conditions. Number 1, the depositors have to give such declaration. Kintanji, this rule is one of the, I would say, isolated rule and contravened rule also. So declaration is required even from others, that is other than directors and the relatives. And what is the other requirement? That company need to specify the application form for accepting or renewing the deposits.
Even though such
From
sum is not considered as a deposit as per rule.
there are there are two different things.
Okay.
There are two different things. When it comes to declaration given by directors, then it is fulfilling two conditions. Condition number one, the amount given by directors will not be considered as deposit. And secondly, that it is also complying the requirement of rule number 10. When it comes to shareholders, what is the change scenario? They have to give the declaration that this is their own money, but the amount is also considered a deposit. So in case of directors, declaration helps in exempting the deposit, but that help is not available when the context is of deposits from the shareholders or members. Now, what I was trying to say, Kintanji, declaration is required, but as auditors, let us be very honest with ourselves.
Yeah.
Have we checked whether company has specified any application form for accepting deposits? Normally, what is happening? One entry will be there in the bank statement and the books of accounts that this money was received. One declaration form will be there that this is my own money, not borrowed money. But where is the application form? That application form is not there. And you know what is the lapse? If application form is not there, na, it means it is not a deposit, it is a loan. Because distinction is there between loan and deposit. So after this event, you may search, each of the listener may search distinction between loan and deposit. And the distinction lies primarily in the way offers are made and acceptance is being made. So deposit means I will come to you. Please take my money so that I can earn returns. Loan means you are coming to me. So if I am coming to you as an investor, it becomes deposits. You are coming to me as a borrower, it becomes a loan. For this, we have many judgments. And that's why the rule number 10 is saying that company must have an application form. Why application form? I will come to Kintanji. Kintanji, I need to invest in your company in debt securities. So what you will say? Kamal, give me the check. No. You will say this is the form, fill the form. That is what the requirement rule number 10 is. And number second question is whether company needs to make any administrative nature compliances for accepting deposit. Answer again is yes. For this, we have rule number 12. And what rule number 12 says, which I believe our auditors must always check, company needs to issue receipt, or I should rather write deposit receipt.
This is also for those amounts for which a declaration has been given by the member.
For all the amounts, Kintanji.
I understand.
Exempted and non-exempted, because ultimately receipt to dena hai na, the kind of a acknowledgement slip.
Yes.
And you will write there, this is the amount, this is the interest thereon, whether it is exempted or not, and so on. And if you see the real world, this rule number 10 and rule number 12, people are not bothered about. And that's why the contravention is taking place repeatedly.
Okay.
So from my side, this is the discussion which I planned for this evening, and I would stop my screen share now. I would be happy to answer the questions of the audience, if any.
Thank you very much, Kamalji. This was an excellent and thought-provoking session. I would like to take few minutes, and there are lots of questions. I think more than 800 registrations from all over India have come up, and let me take up some quick questions. And we have around 15 minutes, so let us wrap this up with taking important questions. One of the questions: how should auditors report non-compliance in cases where private companies are treating shareholder loan as non-deposit from friends and relatives?
Companies are treating shareholders' loan.
Companies are treating shareholders' loans as non-deposits under and show it as friends and relatives.
So let us answer this question in this way. First of all, check whether the loan which was obtained from shareholders is falling within the purview of proviso to Rule 3.3, which I just discussed.
Yes.
If I assume that yes, the amount is falling into that threshold, the amount cannot be shown as receipt from friends and relatives because you will write their deposits from members. Secondly, if the amount is received from the members, but it is outside the scope of rule number 3.3 proviso, even then it will be shown as deposits from members subject to the qualification by the auditors that rule 3.3 stands contravened. At least friends and relatives cannot be specified because in fact, if you go by that way, friends and relatives, it will be a very big contravention because private companies are not allowed
Per se.
to receive loan deposits from the public.
Got it.
That will be against the spirit of private company.
Private companies. And when the auditor has to qualify, it will be a qualification or an adverse opinion. I mean,
that depends upon the impact.
Right.
If it is all pervasive, it will be going to adverse.
Okay. Question number 2. There is a company which has no operations, and there are many clients of chartered accountants who have companies with no operation. I mean, how should auditors assess the going concern assumption with no revenue, no promoter support? I mean, how do an auditor justify?
So for this purpose, I would request that people should take a note of a section number 455, dormant company. If company has no operation, first of all, we need to check whether this company is created and incorporated to hold some assets, or second case, we have to check whether the operations are not there for last 2 years. So it will give an indication that the company is inactive company, then it will go into dormant stage and accordingly going concern can be evaluated. Secondly, we may also need to evaluate section number 248, striking off.
Right.
So we have section 248(1) and 2. 2 means company approaches ROC for striking off, and 1 means ROC is coming to your doorstep for striking off. Now section 248(1) says that if company is not into operation for given number of years, that is 2 years, then subject to show cause notice, the striking off may happen. So depending upon that, you may evaluate what is the current circumstance which is observed by the company. And for this purpose, number 3 is SA 570. SA 570 has given 3 indications: financial indications, operating indications, and other indications. So what you can do, you can download SA 570 and refer the paragraph dealing with financial indications, other indications, and operating indications. Prepare a checklist. It is a kind of ready-made checklist over there, kind of ready-made. So just check, tick box checking, and depending upon that, you may arrive at your own conclusion.
Very clear. There is one question which says that how do auditors assess materiality for reporting fraud or suspicious transactions in closely held private companies where promoter directors are also the primary decision makers?
So the question itself has an answer because promoters and directors are decision makers. So and the word fraud is used. So in such a case, the fraud will become always a material event by qualitative factors. So depending upon that, again, if the fraud, when we say fraud, fraud needs to be evaluated on 2 sides: qualitative angle and quantum threshold. And for that very purpose, fraud by default, you may refer SA number 240. By virtue of 240, fraud of this nature always is considered material. But yes, there could be a possibility otherwise also. The promoters and directors are not involved, employees and other officers are involved. In such a case, my answer will undergo a bit of change, keeping other things constant. The threshold amount given by the law, rule number 13, company audit and auditors rules, is rupees 1 crore. So depending upon that, the things will change, answer will also change because the question is not having the exact nature of the fraud and circumstances in which the fraud was identified. It would be tough for me to give a precise answer, but yes, I can give indicative answer. You may refer SA 240 and then you may refer rule 13 of company's audit and auditors rules.
Okay, I got your point. There is one question. Is there any duty or responsibility of a directors who is removed or who has resigned from the company in the middle of financial year? And how do auditors perceive such a situation with respect to reporting requirement?
So let us assume like this: the director resigned. Let us say, take a hypothetical. Let us say June. Director resigned in June 2024. So till the date of his resignation, whatever transactions happen in the company, that director is duty bound to respond to your queries. This is number one. So if you are the auditor and you come to an understanding that one of the directors has resigned or some directors have resigned, you are having the right to approach those directors for seeking audit explanations. This is my point number one. Number second, post resignation, certain transactions have taken place in the company for which director may or may not be legally, I should say, available. Why? Because there could be a scenario he signed a contract before resignation, but the contract was executed after his resignation. So the answer which I gave for point number one will applicable here also, but he is duty bound to explain. Number third, always check if that director has resigned, whether he has joined or is already there in any of the company, which you can check through DIN number of him, and whether that company is a party related to the extent company from which he has resigned. And depending upon that, section 188 compliances for RPT will also kick in. So this we always need to check. Third thing, this could also be a possibility that director resigned and any of his relative was given a position in the company. So here you need to check whether it is a kind of officer place of profit. So again, number of permutations and combinations will come up depending upon the exact scenario. But this is the broader framework in which we have to move in.
Got it. There is one director, and he is holding directorship in two companies, and one of the companies, because of one of the companies, he is disqualified as a director. And because of some default of one company, how do the auditor of the second company, which is a regular company, how do the auditors perceive this? Because director is default because of company B and not company A. Yeah.
In such a case, what you can do, first of all, take the DIN of the director. After taking DIN of the director, you need to check in what all companies he was there. And in MCA portal, generally date of cessation is there. So this could be one of the hint to get to know that whether this kind of event took place or not. Secondly, the MCA portal could be used to download the balance sheets of those other companies in which he is a director, and then you can analyze your own whether this resignation was kicked in or termination kicked in or disqualification kicked in. So ultimately, you need to gather the evidence from external sources, which in our case, I believe, is MCA portal. And this could be the scenario.
Once the disqualification kicks in, and if he has not retired from company A also, I mean, how, and the auditor has to again qualify the books? I mean,
yes, he has to qualify the director's continuity in his audit report by virtue of section number 167, because section 167 says automatic vacation of the office. And when the words are automatic vacation, if you see the first sentence of section 167, the words used are shall vacate the office. Shall vacate the office means no need to pass any resolution. This vacation is by virtue of operation of law. So in such a case, one reporting will go that this director still is continuing, and because it is still continuing, it means to the entire world he is, giving an impression that I am still the director, and because of this, he will be bounded by rule of estoppel.
Estoppel, yeah. So this
He
reporting
cannot deny to the auditor that I am not a director or so.
Okay. So this reporting should happen in the opinion paragraph or the legal paragraph, legal framework?
That again will depend. If say by virtue of his resignation, the number of directors on the board is not getting affected.
Okay.
Then it will go into qualification. If it is getting affected, then it will go into, maybe it could go into adverse also.
I mean, there is one more tab which we discussed during the session. You highlighted regarding the legal framework. I mean,
legal framework, obviously, because when we see section 143, in section 143, only one disqualification is being captured. That is section 164.2. And in this question which we are discussing, 164.2 is not involved primarily. So in that very case, it will not go into other regulatory framework. It will go into residuary reporting. And residuary reporting could be either in a qualification paragraph or in the adverse paragraph, as the case may be.
This simplifies the solution.
So that is what the list given for regulatory framework, that is exhaustive.
Okay. Okay.
Only two things primarily are there. One is Caro, another is that 143.3 list.
Okay. Okay. So we do not discuss about other disqualifications of Companies Act in that. Okay. There is an example and a query by audience says that there is a 100% subsidiary, a private limited is a 100% subsidiary,
Private company is a 100%
subsidiary of a foreign company which is incorporated outside India. The
Right.
company's shareholding is only 1 lakh and turnover is less than 40 lakhs. So,
Right.
so in such a scenario, whether such company can claim the benefit of small company, I mean, small company.
Answer is no, because when you see section 2 clause 85, the words used are holding or subsidiary company. So for any company of which you are holding or for any company of which you are subsidiary, you by default will lose the status of being a small company. This is number one. Number second, when you will read section number 2 clause 87, in section 2 clause 87, subsidiary is defined. And in that definition, one sentence is written. Company includes body corporate. So that very matter, if I come to your question, the person who asked this question, again, the answer will remain same. The small company status will be lost.
Okay. There are many non-small companies who are crossing the threshold of IFCOFR, and many companies, as per the guidance note given by ICI, do not maintain RCM, they do not test controls. So in such a scenario, I mean, the auditors are requesting the client that please go ahead with maintaining the controls, documenting them, listing down ROMM, risk of material misstatement, but the clients don't end up because of cost factor or inexperience. So in such a scenario, the qualification will trigger in Annexure A, and if yes, how?
So first of all, qualification will trigger at two places.
Okay.
First is 143.1 itself. I should not say rather 143.1, 143.3I itself. Then 143.3I, what you can write that the company XYZ Private Limited has not maintained any risk control metrics, etc., due to which we express our inability to give any opinion on internal controls or financial reporting. And then you will make a cross reference to annexure number A. In annexure number A, because facts are not complete with me, in annexure number A, you will check whether by virtue of absence of this kind of SOP or risk control matrix, any adverse remark is required to be given, or it will go just like that. Because the volume of transactions is very low, so the risk may be also low.
So
but here I must say precaution. If these kind of SOPs and RCMs are not there, the auditor must have very strong documentation. I must repeat, very strong documentation to establish the fact that despite not having this kind of RCM, the risk assessment procedures carried out by the auditor were good enough.
So this is a fundamental requirement to go ahead for such an audit of a company. I understand.
Yes.
And if the controls are key controls, then and strong adverse opinion should follow in Annexure A as well. Yes. Okay.
Because if you refer as a 200, no, basic principles ki jahan baat hoti hai, basic principles regarding audit, Asset 200 also gives the kind of impression and indication that cost and time factors, your convenience cannot be the excuses for obtaining sufficient and appropriate audit evidence.
Okay. I'll take one or two more questions, and they are a little bit complex. What's the practical approach to determine control under section 287, subsection 87, for identifying holding subsidiary relationship in layered private company structures, especially when indirect ownership is involved?
Then this is a very broad question.
I understand.
Very broad question, but if I give a kind of a hint, so first of all, please check compliance of section number 89. Section 89 is about that interest, MGT 5, 6, and all these things. Then check compliance of section number 90. Then check, because the words in the query used were control and subsidiary. So at least people do know that the company must be having subsidiary. Now, subsidiary can come up primarily by virtue of two reasons. One is investment control, and second is board control. If the investment control is there in the balance sheet of the company, there must be appearing investment into n number of companies. So you may check that thing. Number second, board control. If board control is there, in that very case, the company must be having some board resolution. Check the minutes. And other thing is, if I proceed in a other direction, these are the three, 4 points. Other direction is, if you say that the concerned control is present by virtue of equity control, by virtue of board control, you may also seek one kind of a affirmation as external confirmation from that subsidiary. So this way, the points could be added up. But yes, the question is very broad, and it may take leaps and bounds to answer otherwise.
It may take a different session. Yeah. We have seen a common, many chartered accountants have seen that clients don't end up taking gratuity valuations or leave encashment valuation, and it is a typical non-violation of AS 15. Assuming the employee count at 20 and the gratuity involvement is very minimal, so not obtaining a valuation report, a gratuity report, will invite a typical qualification in the.
Yes. So what happens when we talk about qualification now? Besides many other things, qualification is having two, I should say, good elements to qualify. Number one is contravention of a requirement, and number second is the amount or impact of that contravention. If I go by this question, although the amount involved for this gratuity valuation is minimal, but we have to ask ourselves a question whether it is a contravention of accounting standard 15 or not. Answer is yes, it's a contravention.
Yes.
So it requires a qualification. But yes, when you report this kind of qualification, you can be a bit polite, or you can be a bit, softer side, that you can simply write, for example, on the basis of information given to us, AS 15 is not complied with, but the financial impact of which is not material on the financial statement. So this way, it could be a softer outlook. But yes, at present, there is no exemption from actual valuation as far as these companies are concerned.
So the answer which you replied, Kamal sir, is usually the answers which are posted by directors in the director report in response to the qualification. So auditor can, in a subtle tone, also retort to such sentences in his. Yeah.
Okay. Because SA 705 is also giving this kind of liberty by saying that you have to quantify the impact of qualification where it is material. If it is practicable. So when I say practicable comes with the materiality aspect also.
Got it. Got your point. I think we have covered most of the questions, and I think the audience today must be very much thought-provoked after this session. I will take just a moment. At the outset, I would like to express our sincere gratitude to Speaker CSC Kamal Garg for gracing this occasion and delivering such an insightful session on decoding audit and compliances of private limited companies. It is indeed a privilege and great honor. Kamal sir, your address was not only enlightening but thought-provoking. Your examples of going concern violation, nuances of small company and cargo applicability. You gave us experiences of lapses in current practice by identifying common errors found in financial statements. Your overview of another angle of CSR profit calculation, the difference between power and duties of directors with respect to the private limited companies. You also explained us impact and reporting requirements of such non-compliance with respect to qualification, emphasis, disclaimer, caro clause. Your real-world examples and deep domain knowledge have left a lasting impression on all the audience. Today on a Thursday evening, more than 800 people are listening to this session. We truly appreciate the time you took out of your busy schedule to be with us today. And thank you once again for contributing. And on behalf of the entire corporate governance and corporate law committee, we give you a hearty vote of thanks. Thank you very much.
Thank you.
Yes. And
thank you, sir. I would like to take this moment to thank our moderator, Kintan sir, along with Kamal sir, who was today's speaker. Thank you for devoting such a precious time of yours to the members of our institute and elaborating on today's topic. I hope the topic was very useful. The deliberations were very practical. I could see like there were some examples like I generally coordinate CSR certificate course in the institute, which is governed under the CLCGC. And the practical example that you gave, it was never been asked by anyone of the participants in the any of the participants in our certificate course. So this is a great insight that I had. I could just share that insight with the faculty, and they will be happy to accommodate that practical example of yours in our certificate course as well. So thank you so much, sir, both of you. I, on the behalf of Chairman Sir, Babu sir, and Preeti ma'am, Vice Chairperson, and on behalf of our Secretary, Committee Secretary, CMM, I extend my heartfelt thank you to both of you. Thank you so much, sir.
God bless you.
Thank you very much.
Dear participants, session is over. The CPE will be unstructured CPE will be uploaded by the committee in coming days. You can check on your CPE portal. Thank you very much, and have a great evening ahead. Thank you.
Kintanji, thank you so much.
Thank you, Kamalji.